everybody. Welcome to Economics with the Honorable David M. Walker. I'm Nick Pallavita. I'll be your moderator for today's show. And today, of course, is a very special day for us because today we're going to look at the economic forecast for 2024. And with that, we have our resident wizard, the CEO of the Stearns Financial Group, a billion-dollar-plus money manager in the state of North Carolina, a graduate of the University of South Florida who I actually went to college with billions of years ago, but we won't discuss that. And he was responsible for us winning the National Chess Championship back in 1977 or 76, I think it was. And so without further ado, we're going to bring in Dennis Stearns, the CEO of the Stearns Financial Group, to give us the economic forecast for 2024. So Dennis, you're going to take it away.
Thank you so much, Nick. So I can give you all a real brief forecast from our top 3 research outfits, one of which has been named top research on Wall Street 6 years running. And that is 2024 will be mediocre with an upward bias, and mediocre with a downward bias. So that's the quick summary. We actually think that there's some opportunities beyond mediocre. And I wanted to start out with this want to lose your money, listen to millionaires, because I think it's really instructive what was talked about on CNBC in November of 2022. Everybody remembers 2022 as the 100-year flood, when both stocks and bonds both had a terrible, terrible time of it. And so what ended up happening is that the CNBC, is it showing up here on the, that's interesting. So it's not advancing. Nick, I may want to send you these slides because for some reason they're not advancing for me. Yep, I am frozen. So let me send you these, and I will continue discussing them in the meantime. Okay, Nick, just sent them to you. And so the CNBC study back in 2022, they asked millionaires, what do you think is going to happen in the coming year? And overwhelmingly, the millionaires said it's going to be a terrible year in 2023. And of course, it wasn't a terrible year, but there were a lot of things that could have gone wrong, from the banking crisis early on, predictions of a recession, probably the most predicted recession in U.S. history that never arrived, predictions of all kinds of problems with politics. And of course, there were all kinds of problems in politics, but we did get a debt resolution that moved the ball forward. Now it's just kicking the can down the road, but that crisis was averted. And the biggest news, of course, was the Federal Reserve raising interest rates at a rate that was historic, only surpassed in speed and expansion by the early 80s, Paul Volcker raising interest rates to break the back of inflation. This time around, the reason was the same, is to try to break the back of inflation. And it turned out that maybe it helped for the Federal Reserve to do that, but the seeds of the destruction of inflation, or the lowering of inflation, were already in the mix. The supply chain imbalances were becoming back in balance. A variety of other things were causing some of those hyperinflation or higher inflation trends to mitigate and come down. And they've come down very, very rapidly. So ultimately, 2023 was a pretty good year. Those millionaires said, nope, going to be a terrible year. And there were two things that were pointed out by Morningstar as reasons the millionaires got it wrong, and a lot of professionals got it wrong. One was what's called recency bias. Recency bias is a behavioral finance bias that a lot of people get caught up in, and that is thinking that things that have happened recently are going to continue to happen. And the second one is groupthink. Now, what's interesting is, you know how everybody who drives will say, oh, I'm a better than average driver. Well, everybody can't be a better than average driver. And it turns out that everybody can't be better than average predictor. And the groupthink, recency bias, those two things, people say, no, I'm not subject to that. And then they have become subject to that. So it's been a very interesting time with behavioral finance, and we're seeing it again for 2024 forecasts. So uncharted investment waters, the reason that I use this title about Magellan lost 2/3 of his ships and died unexpectedly sailing in uncharted waters is that Ferdinand Magellan made a lot of mistakes. Now, he's heralded as circumventing the world. He didn't quite make it before he died, but pretty much made it. And the problem is that he made mistake after mistake along the way. And actually, some of the things that happened, he got lucky. Now, again, I give him credit where credit is due. That he has certainly made history with everything that he did, but these mistakes for an investor can be fatal, or they can simply reduce returns to the point where you're not going to meet your objectives. And then this third one, wishful thinking. Wishful thinking could also be overconfidence. And this is something that we see happen all the time. It is particularly a problem in the male species, overconfidence, and it pops up in all kinds of places. And so again, these are things we just need to be aware of. And guess what? Investment mistakes, over 1/3 of investment mistakes are made because of behavioral finance issues. So here is that slide about the Fed, one of the fastest, steepest hikes in history. And again, that dotted blue line is where we are now. That red line, which makes you catch your breath, is that early 80s Paul Volcker breaking the back of inflation. By the way, almost broke the back of the economy. We had back-to-back recessions. So that was a shock to the system. Well, that dotted blue line is a shock to the system as well. And we haven't seen all those shocks in play yet, amazingly enough. So if we go to the next slide, what you'll see is that there's some pretty interesting analysis done by a couple of Fed guys on the lagged effects of tighter money policy. And so whether you're talking about the GDP, the economic growth, being a bit slower than would be normal, probably not a recession, although that's still a possibility, as some sort of mild recession in 2024. But definitely 2024, you'll see from these charts some downward pressure of this tighter monetary policy. The good news is that if you look at these charts over towards the right-hand side of the charts, you'll see that the potential for improvement is there. And this has turned out to be a very resilient economy. And so if we go to the next chart, what moved markets in 2023? Again, a lot of things that could have been things that go bump in the night. Some of those scare events ended up being crisis averted. Now, again, some of them may be crisis can kick down the road. But what ended up happening is that we had a year where things got better. And just a reminder, stocks, I know they can be odd at times in their movement, but stocks almost always have their best result when things go from bad to a little less bad. I know everybody would like it if they went from bad to good, because then we could say, oh, all the flags are flying green and we don't have any big scary things going on. But by then, stocks have already made some of their biggest moves. And that is a conundrum for those who don't have high risk tolerances or intestinal fortitude. It's also a conundrum for retirees, because retirees, many of whom are going to have a longer retirement than the previous generations, they generally need some stocks in the equation to keep their growth over inflation going, but it can be a bit of a scary proposition. Next slide. And, this shows on the left-hand side what some of the consensus predictions were for 2023. This is a good reason to take consensus predictions, whether they're millionaires or professionals, with a grain of salt. And what actually happened, which is the big green bar, and then the blue bars are the prediction for this coming year. And so on the economy, we actually agree with this, that the economic growth will be more muted, will be less robust in 2024 than it was in 2023, but still not terrible. And from a stock market viewpoint, that lower right one, we actually think that is a bit too pessimistic as far as what stocks could do in this coming year. Next chart. So the 2023 stock and bond returns, again, 26% for the S&P 500, one of those more extraordinary years. International, no slouch, 15%. And that 15% international actually beat the average U.S. stock, and particularly if you remove the Magnificent Seven, those big 7 tech companies. As you can see down below, those Magnificent Seven had a magnificent year. Now, it came off of an awful year in 2022. We're going to look at that in a second. And then the remaining stocks, 13.6%, the other S&P 493, if you will. And then the forward price earnings ratio, not too bad, 15. That's pretty much right on a 25-year average of PE ratios, valuation ratios for stocks. And so that is one of the places we think we should be shopping in, not bearish on the Magnificent Seven, because these 7 companies all are subject to have higher growth rates in the next 5 years. But that elevated forward price earnings ratio suggests some caution. And so again, particularly for more risk adverse investors, we kind of like the equal weighted S&P 500 as opposed to the capitalization weighted S&P 500. Next slide. And so, again, how great was the year last year? Well, this goes back a long ways and looks at what stock returns are year by year. And you will note that last year was on that far right-hand side where stocks have a great year. And so, folks talk about the long-term stock average of 9 to 11%. Well, notice how few times it is actually 9 to 11% of the mill. It's usually much better or worse. And again, that's one of the things that drives people crazy about the stock market. One of the kind of key pieces is that note in there that when you have had a year like we've had, generally the momentum spills over into the following year, which would mean 2024. And so it is true, statistics tell us that it is more likely than not that we will get some follow-on tailwinds from the good year of last year. Next slide. So some of the potential headwinds for 2024, the number one here is our biggest one, higher rates for longer, meaning higher interest rates. And there's predictions for anywhere between 3 to 6 interest rate cuts in 2024 by the Federal Reserve. That is somewhat baked into stock values right now. And we're not sure that we're pretty sure we won't get the 6. We're not even sure we're going to get the 3. And it may take longer for the Federal Reserve to actually believe that the inflation fire is out, if you will. And Chairman Powell has made a number of comments, Cato Institute and other places, that is his number one objective, and of the FOMC committee, to keep that inflation fire out. Geopolitics, certainly headline risk is high. The actual risk, we think, is much lower. And again, history tells us that there's only one time in the last 100 years that geopolitics created a problem for the stock market that lasted a year or longer, and that was Hitler's invasion of France. We don't see anything of that magnitude potentially coming down the pike in the coming year. Now, there's always that lingering one about, okay, is there a point that China's going to try to take over Taiwan because of all the chips that are in everything made in Taiwan? What is that going to do to stock markets and the world economy? Again, that is probably not a 2024 concern. As big companies move operations out of China, which has been happening more and more, Apple moving their supply chains out of China to India and other places. 5 years from now, it's projected that China won't have as big an economic hit if they ticked off all those Fortune 500 CEOs and had all the things taken out of China that are manufactured there now. So this threat increases certainly every year that we go on. It's a little bit like the federal deficit, that it becomes a bigger issue as we move further forward in the next 5 to 10 years. Unemployment trends deteriorate. Again, we have that at a low to moderate risk. Consumer spending decreases. We have that as a low to moderate risk. It is true that a lot of consumers are going through their big cash hoard, but it is also true that the gross domestic income numbers are very robust. There's a large group of younger Americans in particular making income well beyond what previous generations made at the same age. And so consumer spending, when the going gets tough, Americans go shopping. And so we think that is going to continue to happen. Maybe not quite as robust as this last Christmas season, which was much better than expected. Recession, again, we have low to moderate risk of a recession. And if there is one, we think it'll be mild. And then Fed misstep, we have that as a moderate risk. just a reminder, the Federal Reserve is a blunt instrument, not a scalpel. And so we have been fairly critical of them on different things that they've done, including waiting so long to raise interest rates and shocking all the markets with it. So it's possible that the Fed could make another misstep. Next slide. Now, some of the tailwinds, probably number one on the hit parade, is improving corporate profitability in the coming year and years. And we have that as a moderate likelihood. And the prediction right now for the S&P 500 all stocks is an 11% increase in earnings. We think that might be towards the high end based on other research we've done, but it's 9 to 11 is not out of the realm of probability. And again, you need some of those for those higher flying stocks. You need that earnings growth to support those companies. Good reminder, again, we're not saying this is going to happen this time around, but good reminder that it took Microsoft 12 years to get back to its year 2000 peak. And in the meantime, the company was doing really good work, going gangbusters and growing their earnings, but they had just gotten overvalued. So valuation matters. Now, we're not saying Microsoft's going to go flat for 12 years going forward. In fact, we think Microsoft's got a lot of good things cranking. But we are saying be a little bit more careful with the high flyers at this point. Inflation trends continue improving, especially shelter inflation. Some of that's just math. The shelter is a lagging indicator. And so that is definitely going to be improving in the coming months. But we'll show later some of those inflation trends that we think might be a little bit more sticky. Economic growth above low expectations. Again, low to moderate likelihood that we'll get a gangbusters growing economy. AI productivity gains, actual. Well, AI creating extra productivity, we work with companies all around the country who are doing work with major companies right now, increasing productivity. So we know 100% this is real. This is a real trend. However, the moving the needle, making material gains in earnings, profits, productivity of workers is in the years ahead of us. So this is going to be sort of a ballistic missile shot where right now it's taken off. And so low to moderate likelihood that this will impact 2024, pretty darn high likelihood it'll impact profitability 5 years from now. And then infrastructure spending, this is a Michael Jordan layup, the high likelihood, mainly because the infrastructure bill, which I'll remind everybody was bipartisan for the infrastructure bill, not to be confused with the Inflation Reduction Act. Infrastructure bill, most of the spending starts this year, 2024. And we've got spending of $1 trillion a year, actually because of private spending, even more than that, that will be happening for a number of years. This is one of our number one themes going forward. Next slide. So in the past, we've shared some of the strategics research, again, 6 years running, number one macro research outfit on Wall Street. They are very good at kind of thinking through the big picture. And this shows what they call the balance sheet, a little different than we normally think of a balance sheet. The assets are things that are going right in the economy. Liabilities are things that aren't going so right. And then neutral are those things in the middle. And you'll notice there's a bunch of neutrals. And then you'll notice the chart at the bottom early, basically a year ago, early 2023, we had many more things going wrong than right. but that has steadily improved to now, and -1 for us is statistically immaterial. In other words, +1 to -1 is basically neutral. A number of the things that are in the neutral category are a little bit worrisome for the next 6 months, but a few of them are definitely going to move over to the asset curve. So again, this is one of the reasons why I said at the top of the show, mediocre is the battle cry for the coming year for some parts of the economy. Next slide. So this is one that everybody frets about, particularly if you look at the credit card debt. Now, as I've reminded listeners of this program before, never look at one data point. It will get you in trouble. So if all you do is look at credit card debt, you go, oh my goodness, it's at record high numbers. Well, you have to look at it relative to the income of the credit card folks. And yes, the lower quartile, the lowest quartile of the American population are getting in a bit over their heads in terms of credit cards. But the ones who are really keeping the economy moving, the upper two quartiles, they're not in terrible shape. And that's that lower right chart. It takes everything into account, all the debt of a particular household compared to their income. And again, that's what you have to look at. And you look at that chart and you say, well, gee, that doesn't look terribly worrisome. Now, I will tell you that we work with a lot of banks, and we have a number of bank research folks in our network. And the banks are worried right now about used car auto loans to the lowest quartile of their consumers. So again, it's not that there aren't things to be concerned about, but writ large, this one is not something to be worried about. And then the upper right basically shows you that cash hoard, that amazing cash hoard that consumers have had, and how they've been working it down. Well, guess what? That blue line of cash, it's now under $1 trillion of cash sitting on the sidelines, money markets, savings accounts, whatever. That blue area is mostly held by families making either joint or individually over $100,000 a year. And 30 years ago, that was a minority. It's amazing how many people make that today. Why? Well, just look at graduates coming out of college and what they're making because of the labor shortages. And again, it's an amazing amount of people who are over the $100,000 income limit. Now, parts of our country, $100,000 is hard to make a living in for a variety of reasons. So we're not saying these are the rich folk. Under $100,000 of income, interestingly enough, almost no savings on average. So again, a bit of a bifurcated economy, but it's always a bifurcated economy. There's always things like this, anomalies going on. Next slide. So the one that everybody likes to fret about, federal finances, we're kind of in the moderate fretting category. And you look at the potential, again, never look at one data point, compare it to something else. You look at the debt compared to the economy. And on the lower right, we're looking at forecasts that are getting out to some higher numbers that could crowd out different types of spending, and particularly with higher interest rates on that debt. Now, the forecasts that we have for interest rates on the debt are due to come down. Those interest rates are likely to be a bit lower 12 months from now. And so that will help with some of this. Again, it is unfortunate that there was a squandered opportunity by both of the last presidents. So this is an equal opportunity to be upset at both political parties squandered opportunity to refinance some of our debt at lower interest rates and longer maturities. We have a lot of debt coming due, like a third in the next couple of years. And so, again, the good news is that it looks like we will be able to handle it without a crisis. But all of the things that have happened in the last 24 to 36 months have exacerbated this as a potential problem, maybe not in 2024, but certainly sooner rather than later. Next slide. So this looks at something called trueflation data. Trueflation comes from a research outfit called Trend Macro. They're very good at what they do. And for those of you who have said, you know, I knew inflation was higher than the government was reporting in the middle of the pandemic, well, you're correct. Based on 13 million data points for trueflation, the government, and I put this in quotes, only uses 80,000. I mean, 80,000 is still quite a few data points on things that you buy. But the 13 million is the blue line you see on the right, and it shows inflation being higher than the government numbers. Now, you will notice that that inflation has come back down and come down below, not a lot right now, but come down below the government numbers. Again, for everyone's individual budgets, we have studied hundreds of our client budgets and found that they're subject to somewhere in the vicinity of 60 to 80% of the inflation that the government talks about. So it depends on what you're spending money on. You know, the average amount that you spend on food, for example, the average in the country is 11. Our average is actually closer to 9 to 10 on food. And whether you eat out, the last 3 months, inflation for restaurants has been over 5%. Inflation in grocery stores for the average thing that people buy has been more like 2%. So again, very much depends on what you're buying. I will tell you that my recent trip to the grocery store, I found pork to be a wonderful bargain, and chicken. And again, will this be enough to keep the Federal Reserve from raising interest rates and maybe even cutting them in the next 12 months? We think the answer is yes. Next slide, please. And for an investor, you want to be in the green zone. You don't want to be in the red zone. So the green zone is when you have more moderate inflation, your price earnings ratios on stocks tend to be higher. And a lot of good reasons for this, including companies subject to higher inflation. That's a pressure on their profit margins. But also in the red zone, you tend to have higher interest rates that can be a competitor, if you will, to stock returns. So we're now back in the green zone. Good thing from an investing viewpoint. Next slide. Now, this just reminds everybody about the Magnificent Seven. So the Magnificent Seven is that gold line. And the fact that the Magnificent Seven had a pretty tough 2022, and then they had a rip-roaring 2023. But math doesn't lie. And when you go down a lot in percentage, you have to come back up a lot more just to get to even. So you'll notice the Magnificent Seven are now above the S&P 493, but not as much above as most might have guessed. And so again, this just gets back to, most people have a core portfolio and they have an explore portfolio. Don't confuse the two of them. The core portfolio, try to avoid these big downdrafts because they will be tough to dig out of. The Explorer, hey, go for it. This is the techno-industrial revolution. We got things going on in the next decade that are going to just knock everybody's socks off. Healthcare, every category is going to have amazing technological improvements and stocks that will benefit, but some of those stocks will be extraordinarily volatile. Next slide. So now we get into a little bit further than the next year. We're looking at a 10-year forecast. This is Bank Credit Analyst, very credible at what they do. What you see on the left column is the past 10 years, pretty good 10 years for a lot of different asset classes. Then you look at their forecast for the next 10 years, and your eye might go directly to U.S. equities, U.S. stocks, as being kind of a mediocre, meh kind of number. And again, that is a nod to where we are with valuations at this point. And if we go to the next slide, you'll see a little more upbeat forecast from our friends at Riverfront. And, they're looking at a bit higher returns for U.S. stocks, but not the numbers we're used to, not 10% a year. So if you're building that into your own assumptions for whatever asset allocation you have, you might be a little bit overconfident in building that in. So we're going to probably get okay numbers. We're just not going to get rip-roaring kinds of numbers. Now, it is interesting, international, and this is generally true of a number of these longer forecasts, have a bit better expected returns. And again, that's a nod to valuations. Next chart. Now, this is a presidential election year. I wouldn't be doing my job if I didn't say, here's what normally happens in a presidential year for U.S. stocks. First two quarters are kind of but positive. And then after the uncertainty goes away, regardless perhaps of who is elected, because I remind everybody that given a split houses of Congress and presidency, whoever gets elected is not going to be able to just run ramshot over the other side. But generally, when the uncertainty is lifted, stocks do better. And that is really the main takeaway, because we've had such unusual, uncharted waters the last few years. Literally some things that are 1 in 100-year events that I take this chart with a little bit more of a grain of salt. But I do agree, once the uncertainty is lifted, the stock market should do better. Next slide. Now, this is just a reminder that, we all have these companies that we know and love that perhaps you've made a lot of money on in your investing. The stocks that you may not even know the names of many of them are listed on this, and these are the indexes, much less having an active stock picker looking at different things. There's a lot of really good, solid companies out there that you may not even know what they make or what they do that have good prospects going forward. So again, this is where we would prefer to be fishing in certainly the coming year, but the coming 3 to 5 years. Next slide. And this gets back to that valuation matters piece. International equity valuations on the right-hand side, you can see are generally a third less than the United States, and their earnings prospects are not quite as wonderful, but they're not bad. And oh, by the way, dividends for most of these companies are better than the U.S. So this is the reason why a number of those forward-looking forecasts are saying, international, make sure you have some of that diversification. Next slide. All right, this is my number one slide for thinking about diversification for those of you who say, oh, I missed that big S&P 500 last year, or are especially proud of yourselves because you had a lot in the S&P 500. This is a reminder to be a little bit more balanced about that approach. And so you look down over the last 20 years, and you have very few years where you're going to be dancing because of diversification. In fact, many of the years you will be saying, oh, I missed out on the big returns, even though you made fairly decent returns yourself. Well, look at the bottom line. Bottom line is, over this 20-year period, that diversified portfolio has made almost exactly what the S&P 500 has, with a whole lot less Maalox moments, a whole lot less times when you would have been completely frightened out of your mind, particularly if you're retired, if you had 100% in the S&P 500. So I know it's been popular lately to say, oh, diversification is broken. Well, the fact is that we think the new 60-40, 60% stocks, 40% bonds, was the old thing for a retired investor. Rethink that to 60% growth investments. They could be public, they could be private, they could be semi-public. There's a whole bunch of new things available out in the marketplace. So 60% growth and 40% risk mitigating. And no question, bonds are back in town after we had the lowest bond weighting in our history the last decade, because we just weren't making much money on it, and they weren't providing the right kind of defense compared to bond alternatives. Well, bonds where they are now, they're not only making better money, but if we do get a mild recession, they're probably going to do what they did in 08, 09. They will go up while everything else is going down. So again, think of that 40% not as bonds, but think about it as risk mitigating assets. Next slide. So these are some of those things that are different than stocks and bonds. And the transport over on the left, first of all, the size of the bubble represents the size of the yield or the income coming off of each of these. And then the left axis is what the returns have been. And then you see over time, you also have the S&P 500 and the bond index is together, the 60-40, compared to this mix. And basically, these alternative assets are really interesting to diversify with in the current environment. And so that's why we say, let's rethink what a normal 60-40 is. Next slide. So what do we think are the potential opportunities? Well, for growth and income investors, that usually means retired, but we have a 35-year-old couple who have very low risk tolerance and very good savings, and they can meet all their objectives being growth and income. So not always, but usually this is a retired individual or couple. And you'll notice we like bonds. Particularly intermediate duration. We do believe that one of the biggest traps that's been set up now is having high interest rates on the low end of the maturity curve, the next 6 months, a year, 2 years for CDs, treasuries. And so a lot of folks have loaded up on those thinking they have safety of income. Well, they do have safety of getting paid the income. They don't have safety of the level of income. This trap over the last 20 and 30 years has caught people many, many times. And right now, that trap is laid again. Quality U.S. and international stocks, you'll notice we say focus on good stock pickers. So coming out of 08, 09, we were more index oriented, more passive investing in indexes. Today, 7 out of 10 of our top managers are active managers, and we think it's a stock pickers market. Higher quality private credit. This is one that for those folks who can qualify for private credit usually means you have to be an accredited investor. This has been an extraordinarily good area for us for actually a number of years. Infrastructure, I mentioned that before, and you can see a whole bunch of different kinds of infrastructure all look really good. Now, very few of these are going to make, S&P 500 like last year returns 20% plus, but they're going to make really steady 8 to 12 kinds of numbers. And for most growth and income investors, that's good for their core portfolio. Now, for growth investors, we also like quality U.S. and international stocks, and again, focus on good stock pickers. We also add in here quality small cap stocks. There is the potential, growing potential, I might add, for a profit breakout from a number of these small companies. And many of these small companies, including the value companies, which are less richly priced, are tech enabling like we've never seen before. And this is, again, may or may not move the needle big time on earnings in 2024, but the next 3 to 5 years, it is going to create some meaningful tailwinds, that tech enabling. Then for growth investors, private equity, we work with both the biggest ones in the world, as well as niche private equity are all interesting. And venture capital, for those who can afford to splash around in that area, venture capital and private equity both became much more intriguing after the Silicon Valley Bank collapse in 2023 and all the banking crisis, and it created a revaluation. We invested in a great company out in Silicon Valley that the valuation was slashed on this company, even though they had increased their revenue significantly. In this case, we're co-invested with Mark Cuban, the Shark Tank fame, and the prospects for this company are great, and yet we didn't have to pay up for it, courtesy of, thank you very much, Silicon Valley Bank and all the, I will say, not intelligent decisions that their management team made. So for those who can splash around in that area, and again, these are generally higher net worth individuals, take a look at both private equity and venture capital. Next slide. So there we are. That is all that we think could be going on in 2024 and beyond. And Dave, is this the part where you say the debt?
We had a lot of interesting.
That's going to bite us sooner than.
No. My understanding is that we're going to talk about the economy in 2024. You had a lot of very good, interesting information, Dennis. Thank you very much. I know you were very successful at what you do, and you had a lot of slides. But it wasn't quite death by PowerPoint. You cut it off before that.
I stopped short of death by PowerPoint.
Yeah, I'm on the Defense Business Board, and the Pentagon is infamous for death by PowerPoint, and they're trying to get better. But you had a lot of great information. Let me give you my opinion, short opinion of 2024 on some key metrics, and then I'd be interested in your reaction to it. Okay?
Sure. Yeah.
GDP, slow, but not negative. Inflation, slight reduction, but still above the Fed target rate. Real wages, largely stagnant. Interest rates, somewhat lower, especially in the second half. Unemployment, stable. Labor force participation, slightly down. Deficits, up. Interest expense for the federal government, up, because the compounding effect of more debt, and we didn't lock in the lower interest rates, so we're rolling over debt at somewhat higher interest rates. And then debt to GDP, up. So those are just a few of my bottom line things. I'd be interested in your reaction to that. Notice I didn't get into the stock market. That's your business. Although I will tell you that I recently published an op-ed that talked about why is there a disconnect between what the administration is telling us how we ought to feel about the economy and how most Americans actually feel about the economy. And the big difference is that they go based on trend data, and most Americans look at, am I better off today than I was before? And those are fundamentally different analyses. And even, for example, let's take the S&P as an example. The S&P is up less than 10% net of inflation since January 20th of 2021. And I don't like Trump or Biden, let me say that at the outset. But it was up 50% net of inflation during the Trump administration. And so therefore, my view has always been, if you're going to really look at, performance, you have to look at how are you doing based on plan, what's the trend, and how do you compare to your competitor or a comparator group? And that's, I think, relevant for lots of things, including politics, which is not a merit and integrity-based endeavor. And I'll just leave it at that.
Yeah. So, Dave, a good summary, by the way. And I agree with all your takes on each individual item. The one that might surprise us, and we're watching this pretty closely, is the labor market softening up. And we're getting a lot of evidence from our network of private companies and some public companies that the labor market is loosening up a bit in places. And by mid-year, bank credit analysts even believes that by mid-year, we will have a neutral. And neutral doesn't mean great. And if you're hiring, neutral just means that we don't have this big imbalance that we've had for a couple of years on supply demand in the labor market. Now, I always remind folks, labor market is different than the talent market. And so many of our clients are having trouble finding good talent. They may find labor. It's just the question is, are they people that are going to work and are going to fit with their culture and all those other things that you look at when you're managing a talent pipeline. And your point is also well taken, Dave, about 401k plans do not have the luxury of being able to have all those risk mitigating, private or semi-private assets. And so they took the full brunt of the hurricane in 2022. Even if you were stocks and bonds, both stocks and bonds had their worst performance together in 100 years. And so those 401k plans, people are looking at them at the beginning of 2022 and the end of 2023, and they're saying, wow, 2 years, maybe I am up because I've been contributing out of my paycheck. Hopefully they continue to do that. Morningstar published some numbers that were just disheartening about how many people during 2022 stopped their savings because they were so spooked by what was going on. Again, behavioral finance mistake, possibly of the decade. And they didn't participate as much as they might have in the ensuing rally in 2023.
And one of the things we've talked about, Dennis, on this show several times is the fact that we need to have a mandatory requirement for people who graduate from high school to have taken a financial literacy and civic responsibility course, because those are two areas where we're sorely lacking. And it's especially relevant when you're dealing with people who most of their retirement savings are in defined contribution vehicles, and more of them are also being given the opportunity for participant directed investments.
Well, and I agree wholeheartedly with that. In fact, our firm, we have sponsored a book to all 6,000 elementary school fifth graders in our county that is on financial literacy. And it's not just handed out, it's actually a class that is taught in those elementary schools. We have done middle school financial literacy and partnered with Junior Achievement on that. And we are doing high school financial literacy. In fact, one of our partners is teaching those courses to 11th graders. And by the way, I can report that all across the board, we're seeing better thinking about money than we might have expected. I don't know that that's coming from their parents. I would hope in some cases maybe it does, but I think that's coming from the fact that with all the issues on social media, and I have a long list of grievances against social media. There's a lot of things that kids seem to be learning about. Hey, the mistakes that maybe my parents made and how to avoid them. So maybe a little silver lining there.
Well, I know we're getting to the end of the time, but let me just say they're definitely not following the bad example of the federal government. That's good. Thank you, Dennis. Really appreciate it. You had a lot of valuable information.
Nick.
Thank you. I was going to say, David, I don't see how you can follow the example of the federal government. Nobody on this panel can get 34 trillion in debt. That's
well, you just have to take off a few zeros. I mean, when you're showing the federal government, you have to eliminate a bunch of zeros. And when you do it that way, it actually communicates very effectively to the individuals. You take in this much revenue, you spend this much, this is your deficit, you add it to your credit card, this is what the interest is. And believe me, you don't want to follow that.
You definitely don't want to follow that. But with that, we do want to thank our viewers from the United States and around the world with economics with the Honorable David M. Walker, our special economics forecast for 2024. So stay safe and be careful.
Thanks, Dennis.
Good to be with you.
Thank you.
As always. Thank you.
Bye-bye.